Hey, good afternoon, everyone. This is Mark from Rightline Trading. I really appreciate your time. If you can hear me okay, if you can just put a yes in the chat box, I'd really appreciate it. Okay, great. Thank you, guys and ladies. So what we're going to be doing is we're going to be going over today really what I consider to be a very forgiving strategy using an optimized formula that is going to provide you with maximum reward on what will be the lowest potential risk. And we're going to be looking at selling options and not buying them. I hear all the time that if you're a smart trader, you're going to sell options because because if you buy them, that's what everyone does, and a lot of them are going to expire worthless. Well, I'm going to show you when it's optimal to sell an option and when it's optimal to buy it. It is very obvious. Now, I just want to go over this quick disclaimer that all signals and trading opportunities that we provide are for demonstration educational purposes only. Everyone understands that trading involves substantial risk and you can lose a substantial amount of money. Always carefully consider your financial position prior to making a trade. And I think it should be known as a matter of full disclosure that every trade that I recommend in the newsletter alert, I take in my real money portfolio in Thinkorswim. And if anyone ever challenges that, they're more than welcome to see the trade. I will snapshot it and I will be happy to send it to you. Now, just a little bit about myself. I graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years. I graduated with a degree in applied mathematics. After graduation, I was inducted in the Phi Beta Kappa Honor Society for graduating in the top 2% of my class. I graduated summa cum laude with honors. And after graduation, it was always my goal to go into teaching and to go into research. So I applied to a number of academic institutions and wound up becoming a full-time professor at Thomas Jefferson University. While there, I published 15 peer-reviewed articles in top-tier journals. I always consider myself to be a scientist, a teacher, and an academician. I've been an invited speaker internationally in many countries and an invited speaker domestically in many cities. And I'd estimate that I've probably mentored close to 30,000 traders, most of them in large groups and some of them one-on-one. Now, our goal is to generate consistent income in any market using credit spreads. Now, when you sell options, you're gonna get paid a credit. When you buy them, you're gonna pay the market a debit. So anytime the market pays you, it's because you sold the options to somebody else. Now, I really feel that jumping between option strategies instead of focusing and mastering and on any particular one or two is really a huge mistake. I mean, you don't want to start looking at iron condors and butterflies and this whole vast array of option strategies, at least until you are the master of one particular type of trade. Now, I believe that there are really only three kinds of trades that you need to take. You need to either sell an option spread, you need to buy an option spread, or you need to trade a put, buy a put, or buy a call. You do not need anything more complicated than that to make a really significant amount of money and trade real successfully. But you have to know what you're doing and you have to do it with a lot of discipline, and it all has to be done in a very formulaic way. so that nothing is open to speculation. You know, there's no gut feeling. It is based on a very rigid set of criteria, which I'm going to give you. So I'm really going to give you the recipe for selling options. I'm going to tell you exactly why we sell them and we choose not to buy them. Now, when you grow your trading account using options that you sell, you're going to gain confidence. Obviously, in order to do that, you need a fundamental understanding of why a strategy works. You can't be given a black box strategy. You can't be told that, you know, some special market pattern is going to work for you 85% of the time, because just trading is just not that simple. I really wish it was. And after doing it for 20 straight years, I can tell you, you have to take into account a lot of variables, but we're boiling it down to a recipe. Now, anyone that tells you that you can only win, say, a third of your trades or 25% of your trades and still make a lot of money or still be a successful trader is simply giving you some BS, because you have to win more than 50% of your trades. I mean, there's just no other way to put it. And I'm going to show you why that is. And obviously, to prevent blowups, we have to use very specific rules and discipline to prevent that from happening. And if they do happen consistently, you're going to lose faith in the strategy and you're going to abandon it. So we have to be trade with a tremendous amount of discipline and have a very, very clear-cut formula in front of us that prevents any given trade from blowing up on us. Now, trading credit spreads or selling options is a very simple and forgiving strategy. It's a tremendous way to generate consistent income because you only need a mild directional view on a stock or ETF. If you buy a call, say for $3 at options expiration, whatever the strike price is, that stock has to close $3 above the strike and then has to move a significant degree further in order for you to make any kind of reasonable amount of money. So you have to take a staunch bullish position or a hardcore bearish position. But when you sell options, you only have to take a very, very mild directional view on the stock. And it's very rare that you can find a strategy that you can be wrong on and still make money, but I'm going to show you that you can. So because it's a forgiving strategy, you have a higher probability of success, and it's really going to help build confidence. There's a defined limited risk and a defined limited reward. That's true of every spread trade. You're gonna diminish your risk when you trade a spread. The downside to diminishing risk is you're gonna diminish your reward. But we're gonna make that risk to reward, tilt very strongly in our favor. Now, why learn credit spread options? Again, as I had mentioned, you can profit if the stock price increases, decreases, or doesn't move at all. So if you take a bullish position, a mildly bullish position, and the stock price drifts down, there's a good chance you can still make money. If the price of the stock just doesn't move at all and just moves sideways in very, very tight consolidation, you can make 100% on the trade. You have a very, very limited loss. I'm going to show you how you never have to worry about the trade blowing up or making a huge move against you because Oh, I'm sorry, hang on. Let me just flip this. Because your risk is limited, and it's a very simple strategy. It's a cookbook strategy, and I'm going to give it to you. It's been optimized in a way that creates a credit spread that is going to give you the best risk to reward, the best shot at getting a winner. And if perchance we don't, we're going to lose the minimum amount of money possible. Now, you probably sort of think that stocks have three directions. They can move sideways, they can move up, or they can move down. But the fact of the matter is that stocks have 5 directions. They can move sideways in very, very tight consolidation. They can move up in a very mildly bullish trajectory. And they can move up in a real strong bull move. Same thing to the downside. They can move down in a mildly bearish direction, or they can make a strong bear move. So there's really 5 directions, and we're going to try to anticipate or have a feeling for what the stock is going to do when we place the trade. Because if we believe it's going to make a huge leap up, we're going to want to buy a call. If we believe it's going to make a huge collapse, take a huge collapse, we're going to want to buy a put. But if we feel it's only going to take a mild move up or down or move sideways, we're going to want to sell a credit spread. Now, if perchance we're bullish and it makes a huge move to the upside, we're going to make 100% on the trade. You know, it's sort of a no muss, no fuss kind of trade. Same thing to the downside. But we're sort of looking for stocks that are going to take somewhat mild directions. Although I'm more than happy, I'm going to show you, we've got the open positions in the portfolio, and we've got quite a few that have just made huge leaps, and we're just waiting for the spread to expire to capture 100% of our credit. So I just wanted to recap that. If the stock is going to make a strong bullish move, we want to buy a call. If we anticipate that it's going to make a mildly bullish move up, we're going to buy a credit spread, a bullish credit spread. A mild bearish move, a mild move down, we're going to buy a bearish credit spread. If our anticipation is a collapse on the stock, we're going to purchase a put. And it's sort of reinforcing that you do not need multiple 3-legged positions. Remember, each one has a bid and an ask. So that legging in and legging out of these trades is not that simple. So when you leg into a spread, it's a lot easier. When you leg in and leg out of simply a call or a put, it's really pretty simple. And we're not going to trade any position that doesn't have a lot of liquidity. So we can walk in and walk out of the position real easily. Now, when do you want to take a credit spread? When do you want to sell a position? And I have found that the best way to look at it is, now, I put at the top that if you create a credit spread, you're selling a spread and the market is paying you money and giving a credit to your account. So you get paid for taking this position. The question is, how much of that credit at the end of the trade are you going to get to keep? Now, consider yourself to be at an auction where you have the ability to be the auctioneer standing at the podium with the gavel, auctioning something off, or to be the buyer in the audience. So when do you want to be the buyer? Well, you want to be the buyer when they're auctioning off something that's valuable to you but the cost is extremely low. You want to be the seller or the guy holding the gavel when you're trading something of considerable value, when the cost is extremely high. So we're not going to sell FEEP options. We're going to sell expensive options. We're going to stick them and let someone else buy them and pay us the credit so that can sit in our account. We have already decided whether the trade is going to move in tight consolidation sideways, take a bearish move, or a bullish move. And because the price of the option is extremely expensive, we're going to sell it to somebody else. Now, because there's a good liquidity in this options chain, someone will readily take it off our hands. So just to recap that, you want to be a buyer sitting in the audience and paying a fee when the option is cheap. And you want to be the seller, the auctioneer, and collect the fee when the option is expensive. Now, what is the key metric that determines whether the price of an option is priced high or priced low? And it's implied volatility. When you move into earnings and the market is projecting, and it's easy to tell just by looking at the options chain on the day that earnings are going to come out, they're going to predict how far they believe the stock is going to move. That's how you trade a straddle, which we're not going to look at. So when the cost is low, implied volatility is low. When the cost is high, almost always implied volatility is high. Now, a lot of people call these volatility trades or volatility crush trades. A lot of people call them time trades, because remember, when you sell a spread, time is on your side. You want the value of the option you sold to get lower and lower in value, so that if you have to buy it back, you can buy it back really cheap. Just sell it and get a $2 or $200 credit, and at options expiration, you have to buy it back for 20 bucks. You get to keep $180 per every spread you sold. So you want time to decay the value of the option. So here is the opposite, where time is always on our side. As theta decay, as we move into that last week, starts eating away at the value of the option, we're going to start making more and more money. And it's a rare trade where you make money over the weekend, because the day of options, if it says 42 days to options expiration, they're including Saturday and Sunday. So if the price of the option spread that you sold doesn't move by a penny from Friday to Monday morning, you'll find that the value of the option has diminished, because 2 days have passed and the amount of money that you can potentially accrue goes up. The only time that's going to happen. All the other times when you buy it and you're facing theta decay, you're going to wind up with an option that is diminished in value. Now, we want to trade an option spread that has a tremendous amount of implied volatility. And that implied volatility is going to inflate the price of the option. Now, we don't want to trade into earnings, but there are many, many things that will increase the volatility of a trade. A lot of tech stocks trade with a tremendous amount of implied volatility. And IV implied volatility is right there on your trader when you look to take an options trade. It's called IV rank on some platforms. But what we want to do is we want to sell expensive options that have that are expensive because there's a huge amount of implied volatility inside the trade. And it creates that bubble. And what we're going to anticipate is that arrow is going to come and head into that volatility bubble. And boom, when it punctures it and volatility leaks out, what happens to the value of the spread we sold to somebody else? Well, it gets really cheap. So if you elect to, you're not going to do it right then, but if you elected to buy it back, you would have the opportunity to buy it back a lot cheaper than when you sold it. And that is what we anticipate on every trade that we take. So finding these trades is a little bit of a task, but when you find them, they really have a tremendous chance of making us money. We're trading with about an 85% win rate. And you can tell exactly the win rate you need based on the metrics of the options we sell. I'm going to show you how that works. Now, this is just a spread I wanted to show. It's off another platform. This is a very crude platform, but it's on Abbott Labs. It's off of another broker. It's not a very common one. I've pretty much closed this up. I still have it open because I think I have $10 left in the account. It's called First Trade, but this is Abbott Labs, and you can see it's taking a bearish position. Every time it moves up, it retraces, moves up, it retraces, moves up, it retraces, moves up, it retraces. Now, I didn't put the 30 EMA in, but the 30 EMA is the critical line. When this retraces to the 30 EMA and we anticipate a bearish move, we're going to sell the spread. We make money. Comes back to the 30 EMA, we sell the spread. We make money. Comes back, we make money. Comes back, we make money. Now here it's eclipsed the 30 EMA. So we may be in a position where Abbott Labs is going to reverse. But we're going to anticipate, just for academic purposes, that we're going to sell another bearish position. Now we're going to sell the 98 strike. We're going to use calls on a bear, and I will go over this, quite a bit. We're going to sell the 98 call. Now, why are we going to sell the 98 strike call? Because that's the 50 delta call. And whether we are bearish, if we're bearish, we're selling calls. If we're bullish, we're selling puts. And I'm going to go over this formula over and over and over again. So we're going to sell the $98 call, and we're going to buy the 25 delta call. So we sell the 50 delta call, we buy the 25 delta call, and we collect a net credit of $207. Now, this is not a great trade, and I'm just putting it up sort of to walk you through a trade, because your maximum reward is $207, but your maximum risk is $293. So I don't like the risk to reward on this trade. I just pulled it out to show you how the trade works. Now, the net credit that you got, now this is what's called a $5 wide spread. The distance between the call you sold and the call you bought is $5. And that's how you get this $293. Here, 293 to 207, it equals $5 or $500. So what we want to do is we want to collect a net credit that's much higher. But for the purposes of walking through this trade, that's what we got. We got $207 on the trade. Now, we are selling a 50 delta call. And because it's a 50 delta call, That's exactly where the stock is. The stock is at 98 and it's a bearish trade. Now the stock, if it stays at 98, we make 100% of that. We keep the whole $207. So you see, this stock doesn't have to move for us at all. It just optimally is not going to move against us, but it doesn't have to move in the direction that we believe. If it does, you know, it's a trade that we're going to have less sweat on. But if it doesn't move at all and it closes right at 98 or below, we're going to keep 100% of the credit we received on the trade. Now, let's say the stock closes below, or I'm sorry, closes above 98. Now, if it closes between 98 and 100.7, now remember, we got $207 of credit on the trade. So if it moves up between 98 and 100.07 to $100.07, we're going to still make money even though the trade went against us. We're going to make some net credit. It's impossible to be able to tell you how much, but at options expiration, we are still going to bank 20%, 25%, 30% of the $207 that we were given at the time we sold the spread. This is what makes it so forgiving. Now, Abbott Labs is not a big mover. I mean, it doesn't have a lot of price action going on. And you can tell that because the implied volatility of the option was low. That's why the net credit we got was only $207. That's why this isn't a trade that I would have taken. But it really does demonstrate how the spread works. Now, let's say it trades between 107 and 103. Now, we're going to take some loss between 0 and $239. That's actually, this is the wrong number. The number is $293. But we're going to lose on the trade somewhere between 0 and $293. That's how much leeway we have. So we're at 98. If it trades all the way up to say 102, way against us, we're going to take a partial loser. The only way we're going to take a full loser is if the trade closes above $103 a share. And then we're going to lose the $293. Now, the number of spreads that you're going to trade is based on the size of your account and your risk tolerance. Let's say that you are willing to risk $1,000 for every trade. So you're going to look at the maximum loss that you can accrue. Here it was $293. You're going to trade 3 spreads. So you're going to take $900 of risk on the trade. Now, in this case, you don't have a great risk to reward, but that's how you're going to determine how many spreads you're going to take on a trade. Now, let's say that on a $5 wide spread, we get 33% of the credit. We're going to get $1.66, and the risk we take is $3.34. You add them up, it adds up to $5. That comes up to a really lousy trade because we have to win 67% of our trades to go to break even. Because for every dollar that we can potentially make, we risk 2. So if we make 2 and we lose a trade, we win 2 trades, we lose a trade, make 2, we lose a trade, we're at break even. So we already know, based on the net credit we get, exactly the kind of win rate we need in order to go to break even and then to move to profitability. Now, if we take the trade where we get a 41% net credit on a 5 wide, now we get $2.07 of credit and we're risking $2.93. Now we're taking $1.50 a risk for every dollar reward. This only requires a 60% win rate in order for us to trade at break even. If we trade at 70% winners or 75% winners, we're going to make really good money. And you can see you win 2, you lose 1, win 2, lose 1, win 2, lose 1. Every time you make 50 cents, 50 bucks, 50 bucks, and that's for every spread you trade. So the bigger the credit you get on the vertical width of the trade, the more it tilts in your direction and the lower the win rate that we need in order to trade profitably. Now, I want to show you a trade that I took. This is back a ways, but I'm only using it as to demonstrate how great the system is when you find a terrific stock. Now, this was on McEwen Mining. Now, I sold the $7 put. It's a bullish trade. That's the 50 delta. I bought the $6 put. That's the 25 delta. And I got a $45 net credit. So the risk to reward here is for every $45 of risk I take, or of credit I get, I'm risking $55. So our win rate here is incredibly high. We only need to win 55% of trades with this configuration in order to make money. Now, if McEwen Mining closes above 7, we get to keep the whole $45. Now, on a trade like this, if you're willing to risk $1,000, you're only going to have a potential downside of 55. You can trade 18, 17 spreads because you're only risking $55. So you're going to make $45 times 16 or 17 or 18 spreads. Now, if it trades anywhere between $7 and $6.55, which is the $45 of credit we received, we're going to make something. And it has to trade below $6.55 in order for us to move into the red. Now, McEwen, this is only a dollar wide spread. So the width of the spread doesn't matter. What matters is the percentage of net credit we get on that vertical width. So if we get a 45% premium, we'll take a $10 wide. Now, I don't like to trade $20 wides because you may wind up having to take a bigger risk than you want in your portfolio. But we only need a 55% win rate, and we're trading at an 85% win rate if we can configure trades like McEwen Mining. Now, let's just take a look at the communication sector. Now that we know it was really bullish, and we're going back to 2021, and I'm just showing you. Now, again, I didn't put in the 30 EMA, and the 30 EMA I consider to be a magic moving average. Everybody has, I guess, what they consider to be optimal, but I believe it's the 30 EMA. Every retracement to the 30 EMA, we are going to sell our 50 delta put, buy our 25 delta put to create a bullish position. Up we go. Comes back to the 15, we create another bullish spread. Comes back, we create another bullish spread. comes back, another, and another, and another. Now, eventually, we're going to take a loss. But if we take 1, 2, 3, 4, 5 winners and 1 loser, we are way ahead. But as soon as the direction changes, now we use the 30 EMA as an area of resistance. And every time the market moves into it, we're going to sell a bearish call spread. We're going to sell the 50 delta call and buy the 25 delta call. Moves back, we sell. Moves back, we sell. Moves back, we sell until we get a change in direction. And that's when we're going to take a loser. But hopefully it's going to be after 4, 5, or 6 winners in a row. And it could very well be that the loser we take is just a partial loser and not a full loser. So here's the formula, and we're just going to keep repeating it over and over again. There's nothing discretionary about this system, and that is what makes it so resilient and so powerful. If we're bearish, we're going to sell the at the money 50 delta call, and we're going to buy the 25 delta call. If we're bullish, we are going to sell the 50 delta put, and we're going to buy the 25 delta put. Now, I wrote that you have to collect at least 1/3 of the vertical width, but I am looking for 40% of the vertical width at the very least, because I want to tilt the risk to reward as strongly in our favor as we can and make the win rate that we have to achieve in order to gain profitability as low as possible. Now, this is just, I'm gonna actually skip that slide. This was off of a scanner. I mean, here's XLV when it was just rocketing to the downside. You would look to take, obviously, a bearish credit spread. You would sell the 50 delta call. You would buy the 25 delta call. The metrics on the trade, your maximum risk is 164. Your maximum reward was 136 bucks. That's a terrific risk to reward. That's the kind of trade that we're looking for. So I wanted to show you a trade that's really optimal. Now, again, this is on the First Trade platform, and it's really kind of primitive, but I thought it was a little bit easier to show you than bringing up my Thinkorswim, which is really what I trade off of. And I'm just going to go through these. Now, the critically important metrics on a credit spread position are obviously the direction. That's going to determine whether we're selling puts or we're selling calls. Now, we want optimally to sell a position that's got 42 days out. That's going to provide us, it's part of the optimization of the trade. You can obviously sell a position that's a week out. You can sell a position that's 3 months out. And I have sold positions that are 3 months out. And I have sold positions that are 3 weeks out. But optimally, we want 42 days to expiration. There are 2 arms of the trade. I'm just looking at bullish. You're gonna sell your 50 delta, buy your 25 delta, or sell your 50 delta call and buy your 50 and buy your 25 delta call. You're going to look at the premium. The premium width is absolutely critical. That gives you the premium percentage, and that is all going to be based on the implied volatility rank. These last 3, 6, 7, and 8, all sort of line up. When IV rank is high and there's a lot of implied volatility, your premium width is going to be excellent, and the premium percentage is really going to be outstanding. And that's the kind of trades that we want to take. Now, I'm just, again, I think I've sort of gone over this enough. So what I'm going to do is I'm going to show you these are open trades that are in our portfolio right now. Now I'm going to open up my Thinkorswim portfolio. I'm going to give you the close price today, so you can see how the position is doing. You see the expiration date is April 19, and you see that we sold the 110 put and we bought the 105 put. When I send it out, it's going to be clearly demarcated. Once the trade executes, I'm going to fold it up just to make the portfolio a little bit leaner. Now we want Toll Brothers, if it trades above 110 at expiration, we're going to keep $185. And Toll is right now trading, if I scroll up here, at $122.23. So I'm looking for 100% on this trade. We're going to let it expire, and we're going to keep the whole $185. This is another open position. This is on Viva Systems. This is another bullish position. We sold the 220 put, 50 delta. We bought the 200, 25 delta. We got a $7 credit. Now we only need Viva to trade above 220, and Viva today closed at $23.41. We got a really nice cushion on both these trades. So we're going to be looking to keep $700 when this thing turns the corner into April. The next one is on Huntington Ingalls. And Huntington Ingalls, let me find it, is trading right at $2.9016. So right now, exactly where it's trading, if it was expiration today, we would keep $750. Now, I love Huntington Ingalls. It is involved in the defense industry. I mean, I think this is going to be another 100% winner. Now here's Pinterest. Now Pinterest is one that's now it's trading at 34.77. Now we need it to trade up to 38 to keep the whole $245. But we have $245 of leeway. So if you subtract 245 from 38, it's 38, 37, 36. It only has to trade to 35.55 for us to be at break even. And Pinterest is trading at 34.77. So we need 70 cents more to hit break even. And then for every additional penny that Pinterest goes up, we start moving into the green. I believe, obviously, right now, we're trading in the red, but we are really close to break even. We're all the way out to May on the trade. And I believe that Pinterest is going to post stellar earnings, and we're going to rock it through 38. But I just wanted to show you a trade that we have to watch every day. I mean, this one is not a gimme. I believe it's going to evolve into a full winner, but right now we're trading just slightly in the red if this is where the trade finished at options expiration. Now, how do I pick the stocks? I have to tell you, it takes a lot of work. I have to do a lot of picking. I mean, it's a matter of hand picking. I mean, you got to go through a lot of stocks with implied volatility, with anticipated high IV rank. And you can get Thinkorswim to show you the stocks with high IV rank, but they're not necessarily stocks you want to trade. You want to trade the best performing sector. The time I wrote this slide, it was energy. Then you want to take a trade in the best performing subsector within energy. It was oil services and drillers. So we're going to pick a stock, a bullish position within these subsectors. So I'm going to look right now. I really like healthcare, and the position that's going to go out tonight. It just so happened I didn't want to send out a trade on Sunday night. Usually I'm going to show you I send 1 or 2 trades out Sunday night. I saw a lot of upcoming market instability. It really saved us a lot of money because you saw what happened on Monday. It was tremendous weakness in the market. Today, the market was really strong. This is what crushes traders that buy calls and puts. There's up and down and up and down, this non-directional movement, but it is terrific for us. And I'm going to send out a trade in the healthcare sector on a stock that I believe may only move $1 or 50 cents higher, but that's all it's got to do. I believe it's a stock that's got no downside, and we're going to take a bullish position. It's going to be a wide vertical. We're going to take a $10 vertical. So we're going to be looking for, I'm going to try to, I think I can get on this trade $900 on a $10 on a $10 or $20 wide. I want to get at least 40 to 45%. I want to get my percentages right. Now, I used to have a scanner. I still do, actually. It's in First Trade, but I rarely use it because it just doesn't give me the optimal trades. All it does is line the trades up by the premium based on IV rank. And you see it's there, you're going to get a 40% credit if you sell the $1. Here it is. You sell the 1505 and the 1250. Your premium width is $1. Your premium's $1. The width is 250. That's 40%. I just don't like the scanner because there's too many additional variables that you have to take into account. I just handpick these trades. But the key that I look at is the best performing sector and then the best performing subsector. And then I look at a lot of metrics, which we'll go over in our live sessions in order to pull out what I think is really the pearl on the trade. Now, I just wanted to show you a couple of others. These are closed trades. Now, Vertiv is now trading about $70, but we didn't make 100%. We got $200 on a 5 wide. That's a 40% credit. We bought it back at 30 cents. We made $170 per spread. That's an 85% winner. And they're not all going to be 100% winners. And sometimes as we approach options expiration, I may close the trade at 80 to 90% and take it off the table because there's something called gamma whip, which I'll explain in the live sessions. But if we can bank 90% plus on the trade, I'm happy to take it off the table. Maybe if we've got a $20 cushion, like we may have with Toll's already up $10 more than we need, and it's not a stock with a lot of volatility. And I think home building is enormous right now. And I'll just tell you why. The Chinese are buying land and they're putting up an enormous number of houses, and then they're just flipping them. So they're building entire communities. That's why if you look at what's going on in the home builders is going up, but the price of real estate is falling. And that the price of real estate's falling simply because of high interest rates. But the Chinese are producing an enormous pressure to build more homes. And a lot of areas and a lot of communities are putting up 50 houses, and those houses are sold almost before they're finished. So they're making an enormous amount of money. Here's another trade, Okta. It was the February 82 put I sold. This is how it's going to come to you. I bought the 77 put. I bought the 77 put, the 25 delta. We got $2.25 credit. We kept it all. You know what Okta's trading at now? Almost 100. That's how far Okta went. Now, I didn't anticipate it would make that kind of a bullish move, but I was more than happy to take 100% of that one. That one had such an enormous margin of error that I was just going to let it go to expiration. Now, our last 37 trades, we have 32 winners, 5 losers. That's an 87% win rate. And I believe that we're going to maintain it. Obviously, I can't guarantee anything. I showed you our open trades. I didn't show you one open trade on the VIX, which is also, you know, it sort of faked me out. I mean, I sold a long dated spread. I never believed the market would trade with such complacency. So we need the VIX to rise a little bit. We need traders to have some fear. But lately, they just are trading with fearless. Now, the VIX is not a stock, it's an index, and it's a measure of the amount of puts and calls that are traded in the options market. And when traders get nervous and they own a lot of stock, they buy puts or sell puts to cover their long stock positions. They're just not doing it. So we're not getting a real bounce on the VIX. We had one opportunity to take it off the table. It was March 15th when the Fed said that it was not going to raise interest rates and it was going to sit pat. The VIX spiked to 19, and we only need the VIX to 17 to get a 100%. So I'm just hoping for that one day of huge instability where we can sweep the VIX off the table. So it goes down to the old adage. You can go back to somebody that sells you something, or you can give my service a try, because I not only teach you, but I take every trade in my portfolio. If they're good enough to send out to you, why shouldn't I have them as well? And I have to tell you, I proportion a significant amount of money to these trades, because with an 87% win rate, they have brought me a significant success. So you can stick with the guys that just power out alerts to you, but will never represent that they take those trades. And if they're so great, why don't they? Why aren't they in them with you? Now, you're going to get optimally 2 credit spreads every Sunday evening, but I can't guarantee that. Like this Sunday, we didn't send out any because I just didn't like the tone of the market. Especially when I saw it Monday morning and the futures were way down, I held the newsletter. And I sent it out on Monday with no trades. The trade's going to go out tonight. And it's only going to be one trade because we've got quite a few open trades. And I don't want to overload your portfolio, because if you asset allocate an equal amount to every trade, which is a must, you can't just buy 1 spread here and 3 here. You have to decide how much money you want to risk on every spread. Doesn't matter if it's 200, 400, 800, but you want to take an equal amount of risk on every trade. If you don't, it's going to hurt you. I'm going to give you the entry, the stop. I'm going to give you everything. I'm in the trade. I'm going to baby you along with it. I'm going to give you multiple updates throughout the week. And let me tell you, I mean, I get writer's cramp sending out all the updates for the service. If anything changes or makes a big move, you're gonna see it in your inbox. Now, I'm gonna set a target. I'm gonna set a stop so that in case something happens, I don't have to rush in and send an email. If if like Okta just on earnings went ballistic and took us out of the trade. So it was easy peasy. We didn't have to do anything. So those are all going to be set. We're going to have bi-monthly live training where I'm going to really bring you up to speed on how I find these trades. It's taken me a long time, but I can give you a good feel for where to look and how to test exactly what kind of credit you're going to get on the trade. And there've been a couple of trades where I'm looking for a small pullback. I give you a limit entry order. I mean, 99% of the services will give you like, the price of each leg, and then good luck. You gotta fish around for the best entry you can, because the following day, it's always gonna be linked as filled. And we've had a fair number of trades that gap through our entry, make a big move up or a big move down, and we just don't get in. But I take that additional burden on my shoulders because I take the trades. So I have to set a limit order, and I give that limit order to you. Now, it is my goal to not only teach you how to trade successfully, to become a master at trading credit spreads on your own. Remember what I said at the beginning? There's only 2 or 3 trade configurations you need to master to make yourself a successful options trader. This is mandatory. You must know how to sell options. You can't buy super expensive options because the risk to reward is going to be terrible. I mean, if you buy an option for $7 on a $100 stock, it's got to move up 7% just for you to get to break even at options expiration. I mean, that's a terrible trade to buy. It's a great option to sell in a spread. So this is a mandatory, in my humble opinion, options configuration you need to master. Now, this is the promotional price. You get, it's only $49 for the first month. You have to put in the coupon code, save $70. And I'll answer all the questions. I see them there. I'm going to get to them. If you want it for a year, it's $6.98. And you have to put in the coupon code, the discount code, save 50%, because it's regular $13.96 and it's regular $119. Now, it's a $49 risk, but it's really no risk at all, because it comes with a 100%, no questions asked money back guarantee. If in the first 30 days you don't like the service, just send an email. I didn't put the email into info at right. You can go to the website, rightlinetrading.com. Our email address is info@rightlinetrading. Our phone number is there. Somebody will pick up. You say you don't want it, we will give you your money back. We don't want you aboard unless you want to stay aboard. We're not in the arm twisting business. We're in the business of, all of us here at Rightline, of trying to create successful traders who join the service because they want to stay. So the $49 up front is really not even something that you're risking. If you don't like it, 3 weeks, send us an email, give us a call, and you'll get your $49 right back. Same thing with the year. At 30 days, call us, we'll refund your money. So let me look at questions. Let me just scroll up so I can get the first one. And let me put my glasses on so I can see them, which always helps. Okay. Can you please show where we find the IV rank on TOS? I just don't have time to do it, and I would have to open up. Listen, when you call, the metrics are all listed out on the options. you're gonna see one that says IV. Now, if it doesn't display IV, simply call that toll-free number. I know it by heart. It's 1-800-934-4448, and tell them you want IV, the implied volatility, to appear next to every option. They will share the screen with you, and they will make it so that you see it. So so don't worry about it, okay? I'm telling you, if you don't see it right in front of your nose when you open up the options chain, it's simply because different metrics are there. Maybe they have theta and gamma and metrics that we're not interested in. They'll do it for you, Vercat, I'm sorry. So you don't have to worry about it. And let me tell you, I speak to these guys so many times during the week, and they're super helpful. And if you call them between 9 and 5 Eastern, the trade desk is open where these brilliant guys will configure your whole options setup when you open up the spreads. And they'll show you exactly how to take the trade. And in the live sessions, I'm going to show you anyway. I'm going to show you exactly how you hold down the control key. And when you do that, you can sell one leg, buy the other leg, and boom, you got the spread. And it shows you exactly what your credit is. So do not worry about that. But if you don't see it right there, just give them a call. I just gave you the number. It's 800-934-4448. You put in your account number. If you don't have it, they'll still talk to you. And this is when they verify it. And they'll make sure it appears. It is a necessary metric for every option you trade, whether you sell or buy, because you want to make sure that the IV rank is low if you decide to buy. So you got to see it. Hey, Danny, I'm a member of your service. Danny, we're gonna schedule one next week. Okay, for sure. This looks fantastic to me. Plan to speak with Rory tomorrow morning. Great, thank you, Mike. I really appreciate that. Great presentation, Mark. Thank you. We will send out a recording. Okay. It's all right here. 119. You know what? I don't even know how much it is after the first month. I swear to God, I do not know. It doesn't go to the regular price. I think it goes to $99 a month. But listen, you are going to decide in the first month whether you think it's worth it. Okay, Lance? So you don't have to worry about it. I mean, it's a very, very modest price. And I'm telling you, at the 87% win rate that we are accruing, I believe the reason I'm giving you the money back guarantee is because I don't believe anyone who joins will leave. I mean, that's just my humble opinion. Some people just it may not be for some people, but it won't be because it's successful. And I'm going to walk you through every trade. So you have 30 days to decide. And I just don't know what it is. I truly, truly don't. I mean, I should have it up there, but I don't. It doesn't go to the monthly regular price. I can tell you that. It's less than that. I think you're going to find that out if you come aboard for the $49. You'll see exactly what the price will go on if you continue with the service. But again, that's totally up to you and if you see value in it. So listen, I thank you all for giving me your time. I know it's valuable, and probably a lot of you have been trading all day and you get worn out. And so again, I appreciate your time. I wish you all the best. I hope to be able to trade with you, and we will be trading together because I take every trade that you do. And I watch these trades like a hawk. I'm up at 8 o'clock every morning to see what's going on pre-market. I watch the earnings reports. I watch every single metric. So if the trade is not going in the direction we like, I'm going to look at all the news, everything, because my money's at stake. And so I am not frivolous with these trades. So thank you so much again. I wish you a great evening, and hope to see you in our live session next week. Everyone have a great evening. Bye-bye.